Hello everyone. The topic that we are going to do today is trade on equity. So what trade on equity means is it deals with what kind of securities or what kind of sources you're including in your capital structure. Now, what is capital structure? Capital structure is the combination of the sources from where you acquire money for your business. Okay, so suppose I need 10 lakh rupees for my organization. Okay, now those 10 lakh rupees, from where am I going to source these 10 lakh rupees? And all the combinations from where I am going to source these 10 lakh rupees becomes my capital structure. Suppose I have sourced all the 10 lakh rupees from equity shares. So my capital structure would be 100% equity shares, right? Or second situation, I have sourced 5 lakh rupees from equity shares and 5 lakh rupees from debentures. So my capital structure becomes 50% equity shares and 50% debentures. That means my capital structure will have equity shares and debentures. Okay. Now suppose third situation, I source 5 lakh rupees from equity shares, 2 lakh rupees from debentures and 3 lakh rupees from preference shares. So my capital structure becomes equity shares, preference shares and debentures. So what trade on equity exactly is? It says that if you have only equity shares in your capital structure, you will not be able to earn more for your shareholders. Okay, why? Because if you include debentures in your capital structure, it will help your organization to have more EPS, that is the earnings will be more for your shareholders, because first this debentures are cheaper source of finance. Okay, so the cost of financing is less, and second they are tax deductible. Tax deductible means whatever will be your income, the interest on that income will be deducted first and then the tax will be applied, which will help your organization to earn more because they have to pay less taxes. Okay, so let's start with it here. So in short, trade on equity says the more debentures you are going to include in your capital structure, the chances are that you are going to have more EPS for your shareholders. Okay, the earning per share will increase with the increase in debentures in your capital structure. Now what will happen is, this situation will only arise when the return on investment rate is more than interest rate on the debentures. That is, if your ROI is greater than interest rate. This situation is only possible when your ROI, return on investment, is greater than your interest rate. That is, until and unless ROI is greater than interest rate, till that time more debentures in the capital structure will increase the EPS. Once interest rate is more than ROI, this situation is not, that is including more debentures in your organizational capital structure will not be favorable. This we will understand with the help of an example. Okay, So situation 1, the total capital is 50 lakh. Equity capital is 50 lakh. That means the total capital required by the organization is 50 lakh, and all of these 50 lakhs has been sourced from equity shares. Okay, so debt is nil. So the debentures or bank loans are 0. Tax rate is 30%. Earning before interest and tax is given 7 lakh. Okay. Now let's move further. Situation 2. Total capital is 50 lakh. Equity capital 40 lakh. That means total capital requirement is 50 lakh. From equity shares, the organization has sourced 40 lakh rupees, 4 lakh at the rate 10 per share. Okay. So debentures, and from debentures it has sourced 10 lakh rupees. Tax rate is 30% and interest on debentures is 10%. Okay. Now EBIT remains the same, 7 lakh rupees in all the situations. Now situation 3, total capital again 50 lakh, equity capital 30 lakh. That means now in the situation 3, organization has increased its debt to 20 lakh rupees. It is only sourcing 30 lakh rupees from equity shares and it is sourcing 20 lakh rupees from debt. Tax rate remains same, 30%, and interest rate remains same, 10%. EBIT is 7 lakh. Now let's begin with the calculation. Now we are studying trade on equity. That means in situation 1 there is no debt at all. In situation 2 there is a debt of 10 lakh rupees. In situation 3 there is a debentures of, there is a debt of 20 lakh rupees. Okay, we all understand that tax rate throughout all these 3 situations is 30%. Interest rate throughout these 3 situations remains 10%. EBIT remains 7 lakh rupees. Okay, so EBIT 7 lakh, 7 lakh and 7 lakh for 3 situations. In first situation there is no interest rate because there is no debt. Okay, all the finance is done from equity shares, so there is no debt. In the second situation there is a debt of 10 lakh rupees. So 10% of 10 lakh is 1 lakh rupees. So we will deduct interest from EBIT. In the third situation there was a debt of 20 lakh rupees. So we'll deduct 2 lakh rupees. Okay, clear? That is 10% of 20 lakh. Now we are left with EBT, that is interest before tax. Earning before tax. Okay, so earning before tax here remains 7 lakh. Earning before tax here is 6 lakh. Earning before tax is 5 lakh in situation 3. Now we will deduct the tax, that is 30% of 7 lakh. 30% of whatever is the earning left, that is 6 lakh, and 30% of whatever is the earning left, that is 5 lakh. Okay, 5 lakh. Now whatever is left is your earning after tax. Let's revise one more time. See, in situation 1 there was no debt. In situation 2 there was a debt of 10 lakh rupees. In situation 3 there was a debt of 20 lakh rupees. The interest rate is 10%. So earning before interest and tax, we will first reduce interest. Okay, interest we are reducing, that is in first situation there was no debt, so there is no interest. In second situation there was a debt of 10 lakh rupees, so interest was 10%, so we are deducting 1 lakh, and we are deducting 2 lakh in the third situation. Now whatever is left out of this amount, out of whatever is left, we are going to deduct the tax. So 30% is the tax rate. We are going to deduct 30% of 7 lakh, that is 2,10,000. 30% of 6 lakh, that is 1,80,000. 30% of 5 lakh, that is 1,50,000. What benefit debentures or debt has given in our capital structure is that it has reduced the amount of taxes that we have to pay. See, there was no tax, no debt in first situation, so we had to pay 2,10,000 as tax. Okay, there was a debt in second situation, therefore we had to pay less tax. And there was more debt in third situation, that is 20 lakh debt, and therefore we are paying lesser tax in the third situation. Clear until now? Okay, so EAT, earning after tax, remains 4,90,000, 4,20,000 and 3,50,000. Now next let's take out the EPS. EPS, the formula is earning after tax divided by number of equity shares. So EAT in first situation is 4,90,000, in second situation it is 4,20,000, in third situation it is 3,50,000. So the shares were, in first situation the shares were 5 lakh shares, right? In second situation the shares are 4 lakh, and in third situation the shares are 3 lakh. So we will calculate the EPS, that is EAT divided by number of shares. EAT divided by number of shares. 3,50,000 divided by 3 lakh, that is the number of shares. So here you can see which situation earns more profit, like more, the EPS in which situation is the highest, that is 1.16 in this third situation, where the debt was highest out of the three situations, that is trade on equity. Okay, trade on equity says that whatever is the debt, your EPS, your earning per share, or the earnings for the shareholders will be increased if debt is included in the capital structure. Okay, because debt is a cheaper source of finance, the interest rate is less than dividend. Okay, and next, because the debentures or the debt is tax deductible. Tax deductible means before deducting tax, we deduct interest rate from the earnings. Okay, that's why whatever is left on that earning, tax is applied. That is what the concept of trade on equity is. That is, more debt you include in your capital structure, higher is going to be the EPS. Okay, but this situation will only occur when your return on investment is higher than your interest rate on debentures. Okay, so whatever is your return on investment, if it is higher than the interest rate, then what will happen is, if you include more debentures in the capital structure, more will be the EPS. Okay, so let's find out in this situation what was our ROI. So to calculate the ROI, the formula is here we are calculating the ROI. So the formula for calculating the ROI is EBIT upon total investment into 100. So the you will ROI is return on investment. How much return, what percentage of return you are getting on your investment is your ROI. Okay, so EBIT, that means the earnings that you have made before interest and tax upon total investment. Total investment पे कितनी earnings आई हैं हमें will be your return on investment. ठीक है, हमने investment करी थी 50 लाख की, ठीक है, we have invested 50 lakh rupees in all the situations, and in all the situations our EBIT was 7 lakh rupees, right? So 7 lakh rupees divided by 50 lakh into 100 gives you an ROI of 14%, which is greater than 10%. 14% is greater than 10%, and that is why in this calculation we were getting EPS more when we were adding more debentures or we were adding more debt. Now let's do one more situation where in first situation total capital is 50 lakh rupees, debt is nil, tax rate remains same 30%, and interest rate throughout all the three situations will remain 10%. Okay, and the earnings are reduced to 3 lakh rupees. So all the situation is same, only the earnings are reduced from 7 lakh rupees to 3 lakh rupees. Okay, so in the second situation we have included 10 lakh debt, and in the third situation we have included 20 lakh debt. Same, only EBIT has changed. So when EBIT has changed, see 3 lakh, 3 lakh, 3 lakh. First situation like previous one has no debt, so no interest. Second situation has debt, that is 10 lakh rupees of debt, 10% interest rate, 1 lakh is deducted. In third situation 20 lakh, 2 lakh is deducted. EBT left is 3 lakh, 2 lakh and 1 lakh. Now whatever is the EBT left, that is earning before tax, you will deduct tax from that. 30% of 3 lakh, 30% of 2 lakh and 30% of 1 lakh. Okay, so after all these deduction, that is deduction of interest and deduction of tax, the earning after tax left is this: 2,10,000, 1,40,000 and 70,000. Now EPS, see here, EPS is least in the third situation, in contrast to the previous calculations that we did, right, where EPS is the highest in the third situation. Here EPS is the lowest in the third situation. So you understand, the more debt we are including in the capital structure, it is reducing our EPS. Why? Because here in this situation the ROI is less than the interest rate. So now you all know how to calculate ROI. You can calculate the ROI on your own. ROI is equal to EBIT upon total investment. ठीक है, तो EBIT is 3 lakh, total investment is 50 lakh, right? So 3 lakh divided by 50 lakh into 100 gives you 6% of ROI, which is less than 10% of interest rate. And that is why if we add more debentures or more debt in this second calculation, we are getting EPS least when we are in the third situation, because in the third situation the debt is higher than the first and the second situation. Okay, so this is the concept of trade on equities. Okay, so again let's revise. Trade on equity says that the more debentures or the more debt you add in your capital structure, it will increase the earnings of your shareholder. That is, it will increase the EPS, earning per share. Okay, but this will be possible only if the return on investment, that is the earnings that you have and the total investment you have made, the ratio of this, that is called the return on investment, is higher than the interest rate. If the ROI is higher than the interest rate, only then the EPS will be higher if you add more debt. But if ROI is less than the interest rate, then the more debt you include in your capital structure, the lesser will be the EPS. Okay, so in crux, what we are trying to say here is ROI, if is more than interest rate, you can add more debentures or debt to your capital structure. It will benefit your organization through EPS. But if ROI is less than interest rate, you may not involve more debt in your capital structure, because it will lead to lesser EPS in your lesser EPS, that is the earnings will reduce by adding more debentures or debts. Clear? This is the concept of trading on equity. Okay, next we will discuss the sources of finance.